In 1992, a man named Daniel Murphy, who owned all the Tim Hortons donut shops and Wendy's restaurants in Prince Edward Island, made an exciting decision. Murphy first started his career operating in the hospitality business and bought 2 Tim Hortons on the island. Since then, he has continued expanding to own 20 Tim Hortons total and 32 Wendy's restaurants. He then decided he wanted to open a new outlet for both brands in the same building in the town of Montague. So, he invited both of the founders, Ron Joyce of Tim Horton and chairman of Wendy's, Dave Thomas, to the grand opening where the two met for the first time. Seeing the success that was garnered from combining coffee and donuts along with burgers, Wendy's merged with the TDL Group, the company that owns the Tim Hortons franchise, on August 8, 1995. But 10 years later, activist investor Bill Ackman saw an opportunity to make some changes to Wendy's ownership of the Tim Horton franchise. Wendy's was founded on November 15, 1969 in Columbus, Ohio, by driven entrepreneur Dave Thomas. Before the founding of the hamburger franchise, Dave was adopted as an infant and moved around with his adopted father after his adopted mother passed away when he was 5. His grandmother played a large role in his upbringing and is credited with teaching him the importance of serving and treating others well. Growing up, Dave took his first job at Riga's restaurant, where the owner treated him like family, teaching him he could be whatever he wanted. When his father was about to move again in 1947, Dave stayed in Fort Wayne, Indiana, to work at the Hobby House restaurant. There, he moved up the chain from busboy to working the fountain and again to the front kitchen with hopes that he would have his own restaurant someday. The owner, Phil Claus, mentored him and taught him a lot about the business aspect of running a restaurant. Phil Claus had bought 4 KFC franchise restaurants in Columbus, Ohio, which were failing in 1962. He then gave his mentee an opportunity he could not pass up, a 40% stake in the restaurants if he could save them. And save them he did. Dave helped simplify the menu with a signature dish as the focal point. Dave also coordinated with Colonel Sanders to be in a number of commercials to help boost sales. After successfully reviving the restaurants, Dave sold his stake back to Phil for a $1.5 million profit. Still having his big dream of owning a restaurant, he saw an opportunity when going downtown in Columbus to get a burger. There, he opened the first Wendy's old-fashioned hamburgers. He named the franchise Wendy, which was actually just a nickname after trying all 5 of his kids' names as the name of the restaurant. The nickname was from the fact that his other kids had a hard time pronouncing his daughter's name, Melinda, so the name slowly transformed to Wendy. The restaurant would be known not only for its fresh beef, but for its unique square-shaped beef that had the corners hang out from the bun. Most beef patties were frozen, but Wendy's beef is transported to the restaurants in refrigerators, and Dave wanted customers to see the fresh, juicy beef corners of their quality. Years later, Dave would resign from handling the day-to-day operations, but this proved to be a disastrous idea as the company went through a period of decline. There was effort to bring him back at the helm, but he instead took more of a front-lines position. He became the TV spokesman, which had a rough start, having no acting experience. But he soon grew on the American consumers as more and more people began to recognize him and knew who he was. Through the many commercials over the years, Wendy's brand awareness increased significantly. After acquiring Tim Hortons in 1995, the two combined brands generated sales of $7.7 billion in 2000. In 2002, Dave Thomas passed away at the age of 69 after fighting cancer for many years. In 2004, Pershing Square began amassing a large stake in Wendy's, and by 2005 was able to send their management a list of demands. Wendy's was about to undergo a corporate raid from one of the most famous activist investors in modern times. Corporate raiding was a common tactic between the 1970s to the 1990s, but became less and less popular with the public opinion and company management speaking out against it. Many businesses started implementing tactics to fend off hostile takeovers, such as a poison pill or increasing debt levels. Unfortunately for Wendy's, they did not. Ackman accumulated a 9.9% stake at an estimated $37 per share and quickly sent a letter to Wendy's management to refrain from making any major acquisitions. There were rumors that they might be acquiring Dunkin' Donuts, Baskin-Robbins, and Togo's chain from Allied Domecq plc. At the time, Ackman had tapped on the Blackstone Group to do an analysis which concluded that the current $48 market price of the company's shares were well below the $60 to $70 intrinsic value. With a strong enough hold on the burger company, Ackman demanded that the company spin off Tim Hortons, refranchise a significant portion of Wendy's operated restaurant, and use that money to fund buybacks of their own shares. A spin-off is where a company will create a new independent company by selling or distributing new shares of its existing business. As Ackman was expecting, it would be worth more as an independent entity, as the two franchises under one management had minimal benefits. Spin-offs tend to increase the return for shareholders because the newly independent company can better focus on the specific product or service. For the two franchises, dividing the two would not only allow the companies to assess each one's performance, it can also allow for teams to be better compensated on it. In addition, franchised businesses can also have company-owned restaurants, which Ackman wanted the company to refranchise, so that the company could focus more of its resources on developing new products, marketing, quality assurance, and better training programs. And finally, using the profits from this demand along with money raised from a Tim Hortons IPO, the money could be used to repurchase shares. After months of pressuring the management and convincing other shareholders to vote in favor of his demands, Wendy spun off Tim Hortons and raised $783 million in March of 2006. The company also conceded to the other two demands, and the shares climbed in the process. After the stock nearly doubled, Ackman sold the last of his shares by November 2006. Soon after, the shares fell from the swift exit and the loss of their largest cash flow unit. Many analysts accused Ackman of leaving the company in worse shape and blamed him for the fall in stock price. Ackman blamed Wendy's board for not listening to him after he objected to their decision to hire new CEO Carrie Anderson. It was estimated that Perishing Square profited over $200 million from this raid. And Bill Ackman was able to add another mark to the win column for his hedge fund. In 2015, Tim Hortons was acquired by 3G Capital, the private equity owners that also own Burger King. With their experience, they were better equipped to help grow the company as they were able to nearly triple Burger King's market cap after buying it for $4 billion. What do you think of Bill Ackman's corporate raid of Wendy's? Does activist investing really help out companies and their shareholders? Leave a comment down below. Also, if you're new to the channel, don't forget to like and subscribe.